School of Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 4 International Business Environment, Unit-13 Sources of Global Financing, Part 2. Trade financing. Financing is an important part of trading goods and services abroad. The exporters may require financing while buying or manufacturing of goods, whereas importers may require the same for the purpose of inventory investment or procuring goods and services from foreign land. There are 5 principal means of trade financing which are being ranked in terms of its increasing risk to its exporters. Number 1. Cash in advance. This offers the greatest protection to the exporter as the transactions are done mostly in cash, either before or after the arrival of the goods. An exporter usually prefers cash terms in situations like a political instability in the importing country or when the buyer's credit seems to be risky or doubtful, as these may cause delays in payments or even completely stop the fund transfers. Cash in advance in such cases enables the exporters to both finance its production and reduce marketing risk. Number 2. Documentary credit or DC. A documentary credit or documentary letter of credit is a form of letter which is addressed to the seller or exporter, written and signed by a bank acting on behalf of the buyer or importer. In the letter, the bank promises to honor the drafts drawn on itself if the seller confirms to the specific conditions as mentioned in the documentary credit. The major type of a documentary credit that are prevalent include: Number 1. Revocable documentary credit. It is a means of arranging payments which doesn't carry a guarantee. Next is irrevocable documentary credit. It refers to the means of arranging payments under specific permissions of all parties concerned, including the exporter. Third is confirmed documentary credit. A confirmed documentary credit is the one which is issued by one bank and confirmed by another, obligating both the banks to honor any drafts drawn in compliance. Then comes unconfirmed documentary credit. Under an unconfirmed documentary credit, it is the obligation of only the issuing bank without being confirmed by another bank. And the last is transferable documentary credit. This type of documentary credit issues the right to the beneficiary to instruct the paying bank for making the credit available to one or more secondary beneficiaries. A documentary credit is non-transferable if not authorized in the credit. The third means of trade financing is draft. Drafts are commonly used means of financing in foreign trade. It is an unconditional order in writing, usually signed by the seller or exporter and addressed to the buyer or importer or the importer's agent, ordering the buyer to pay on demand or at a fixed future date the amount mentioned on its face. It is also known as a bill of exchange. A draft serves 3 most important functions, which include: Number 1. Provision of written evidence in clear and simple terms of a financial obligation. Number 2. Enabling both the parties, importer and exporter, to potentially reduce their cost of financing. And number 3. Provision of a negotiable and unconditional instrument, that is, the payment must be made to any holder despite any disputes over the principal commercial transaction. Drafts can be negotiable under certain conditions. They are: Number 1. It must be in a written format. Number 2. Must be signed by the issuer or drawer. Number 3. Must be an unconditional order to pay. Number 4. Must be a certain sum of money. Number 5. Must be payable on demand or at a fixed future time. And number 6. Must be payable to order of bearer. Drafts can be of following types. Number 1. Sight drafts. They are drafts paid on presentation or else dishonored. Number 2. Time drafts. Drafts payable at some specified future date. A mature time draft is termed as its usance or tenor. A mature time draft is termed as its usance or tenor. A time draft is said to become an acceptance if it is being accepted by the drawee by authorizing with the signature and date. A draft which is accepted by a bank is termed as banker's acceptance, and that drawn on and accepted by a commercial enterprise is termed as a trade acceptance. Third is clean draft. This kind of draft is not accompanied by any other official papers and is usually required for non-trade payment settlements only. It is primarily focused on pressurizing any non-compliant debtor to pay or accept the draft, failing which may lead to damage to its credit reputation. Failing which may lead to damage to its credit reputation. And the last is documentary draft. Such a kind of draft can either be sight or time drafts and are usually accompanied by other official documents which are to be delivered to the drawee on payment or on acceptance of the draft. The official documents include mainly the bill of lading in negotiable form, the commercial invoice or trading, the consular invoice, that is, documents certifying the shipment of goods and shows information such as the consignor, the consignee, and value of the shipment, and an insurance certificate. The fifth means of trade financing is consignment. Under a consignment, goods sent are only shipped but are not sold to the importer. In this kind of an arrangement, the goods are left in possession of an authorized third party to sell. The exporter or consignor, on selling goods in consignment, draws a portion of the profits, either as a flat rate fee or commission. Goods and services sold in the consignment arrangement mode can be of low commission and low time investment way of selling. This mode of financing usually involves large risk. The exporter need to carefully verify the credit risk involved along with the availability of foreign exchange in the importer's country. If the buyer defaults, it becomes difficult for the exporter to collect the payments for his shipment. And the last means of financing is open account selling. Involves shipping of goods first and then billing the importer later. The credit terms are arranged between the importer and the exporter, and in these kinds of arrangement, the exporter doesn't have much information about the importer's obligation to pay. Open account selling is usually preferable with the foreign affiliates or with a customer with whom the exporter has a long history of favorable business dealings. Open account selling has seen a vast expansion with increase in the volume of foreign trade, as it has witnessed an improvement in credit information about the importers and a greater acquaintance with the exporting in general. The benefits of an open account selling include greater flexibility of trading and payments, that is, no specific date of payment is set, lower cost, and fewer bank charges. Banks and trade financing. Banks are usually involved for providing loans or a documentary credit when it comes to financing foreign trade. However, as financing became a fundamental aspect of trading, the banks, especially the international banks, have started evolving as well. The banks now provide financing of discrete trade deals and assist with comprehensive solutions to trade needs, such as facilitation of combined lending by banks with subsidized funds from the government export agencies, international leasing, other non-banking financing resources, along with other associated political and economic risk insurance. American Depository Receipts, that is ADRs. A negotiable certificate which is being issued by a US bank and represents a specified number of shares of a non-US company which is being traded on a US exchange is termed as an American Depository Receipt. They are measured in US dollars and are transacted in the US stock market similar to stocks of any other US company and are issued in US by an US bank. The ADRs are listed in either New York Stock Exchange or the American Stock Exchange or the National Association for Securities Dealers Automated Quotation. The ADRs are listed in either New York Stock Exchange, that is NYSE, or the American Stock Exchange, that is Amex, or the National Association for Securities Dealers Automated Quotation, that is NASDAQ. ADRs offer the US investors an opportunity to purchase stocks of foreign companies in the US market in US dollars. On the other hand, it also benefits the foreign companies by enabling them to attract American investors and trade its share in the US market without the hassle and expense of listing in the US stock exchanges. ADRs can be sponsored ADRs or non-sponsored ADRs. Sponsored ADRs. When a foreign company enters directly into an agreement with the Depository Bank of US for maintaining records, communicating with the ADR holders, payment of dividends and other shares, they are called sponsored ADRs. When there is no involvement of any US depository bank and the foreign company wishes to establish itself in the US trading market with the help of a broker-dealer, then it is called non-sponsored ADRs. There are three types of ADRs. Level 1 ADRs. These ADRs does not intend to raise capital. They are listed in the exchange and traded only over-the-counter market. No information about the issuer company in the US Securities Exchange Commission, that is SEC is there. Level 2 ADRs. These ADRs are either listed on an exchange or quoted on NASDAQ. They too, like the Level 1 ADRs, do not wish to raise capital but are required to file annual reports in the US Securities Exchange Commission, that is SEC. Level 3 ADRs. The most important category of ADRs which are issued to raise money and trade in the US exchange market are Level 3 ADRs. They are also required to file annual reports to SEC. In case of the sponsored ADRs, a fee is charged by the US Depository Bank while making an agreement with the foreign company for rendering its services to the ADR holders. Such a fee is called the custody fee and is often deducted from the gross dividend by the foreign company, and the net dividend is paid to the ADR holders. Global Depository Receipts or GDRs. A bank certificate which is issued in more than one country for shares in a foreign company is termed as a Global Depository Receipt. They are listed in two or more markets, mainly the US and the Euro markets are denominated in a freely convertible foreign currency. A foreign company issues shares to the depository bank of the share trading country. The depository bank then issues GDRs against these shares. Repeat. Against these shares to the investors of the other foreign countries. In case of GDRs, the GDR holders are not the shareholders of the share issuing company. The depository bank becomes the main shareholder of the issuing company and also has the voting rights. Trends in India's global sources of financing. Indian domestic markets have been sluggish when it comes to raising of funds for their business needs. As a result, Indian companies have shifted their focus towards international fundraising sources through several traditional and non-traditional channels available, some of which are: Number 1. Equity-based channels. They're open for the Indian business environment as a source of financing. They may be in the form of: First is foreign direct investment policy. They may be in the form of foreign direct investment policy, which is a liberal and balanced policy where global investors can invest in almost all sectors. Saving in a few sensitive sectors like retail and insurance is quite easy as 100% foreign equity participation is available. They can also be investment funds in the form of pure financial funds, sovereign funds, social impact funds, or other related institutions have at least two main attractions for. They may be in the form of investment funds as well. Investment funds in the form of pure financial funds, sovereign funds, social impact funds, or other related institutions have at least two main attractions for investments. That is, investing in the industry or sector of the target business customers and having an appetite to invest in India. Third form is partnership with foreign companies through joint ventures. It works best if the partnering companies belong to a technology and capital-rich country. Joint venturing allows access to the capital markets of the foreign partnering companies for additional equity and low-cost debt. Some European economies have the foresight to invest in emerging market economies in order to overcome the saturation in their own investment sectors. Next is listing of Indian companies in stock markets and other alternative investment exchanges, which is available in most of the advanced economies. This can be available through organic listing by means of an initial public offering, that is IPO, or with the help of a reverse merger with an already existing company followed by stock offerings. Canada, US and Singapore stock markets are best suited for such kind of transactions. And the last is equity guaranteed debt. Equity guaranteed debt rely on the reputation of a joint venturing partner or a significant partner shareholder that floats a loan for the Indian companies and guarantees it locally, thereby making fundraising by Indian businesses easier and more economical. Debt-based instruments. Debt-based instruments include major banks and other financial institutions as primary choices of raising debt funds from foreign sources. Quite a handful of commercial banks in major economies like US, Japan, China, UK, Switzerland, Canada and Taiwan provide funds to Indian businesses for financing their business needs. Debts from banks and large financial institutions such as the World Bank, the International Monetary Fund, the US International Development Finance Corporation, and the Asian Development Bank are mostly suited to finance Indian projects of economic importance. Smaller banks and debt funds are mostly accessible to the MSME sectors for providing loans and funds with an interest rate higher than the larger institutions but lower than the domestic funders. Partner companies through joint ventures provide channels for funding through their own banking relationships by leveraging low-cost debt themselves, followed by a low-cost debt as another alternative lender to its own business under the current Indian external commercial banking policy. Besides business development funding, there are certain European banks that are willing to finance global businesses of their clients by providing debts at economical rates in emerging economies like India, as long as the foreign partner company is a part of the business. Alongside these financing options, Indian business firms are now open to trade factoring in businesses with reputable importers of their products. Export finance is greatly beneficial when buying capital goods from advanced economies like US, Canada, China, and Japan. Extreme low-cost financing options are also available for the right customers in India. Setting up of a subsidiary of an Indian company in a foreign capital-rich economy is another option of securing low-cost finance, as many schemes and opportunities for growth can be availed using this method for the reputable business firms in India. Foreign capital markets are thus a valuable source of financing for the Indian businesses, and it is a perfect opportunity for them to access such global capital markets and accrue more of capital reserves in the near future. Now let's summarize the unit. Global trading is an essential factor for determining a country's economic growth prospect, but it also comes with some cost involved during purchase and sale of merchandise across geographical boundaries, such as costs associated with the shipment of goods, payments to exporters, etc. A country with a strong financial backbone can bear all its financing of trade expenses. However, with the passage of time, cross-border trading relations strengthened and several sources of trade financing have emerged for the trading countries in the form of foreign direct and foreign portfolio investments, external commercial borrowings, foreign aid, American depository and global depository receipts, and international money markets, which includes euro currencies, euro bonds, euro notes, etc. As far as the payment terms between the exporter and the importer is concerned, 5 additional means of financing trade have been identified and ranked as per the associated risk for the exporters. Such means include payments through cash in advance, drafts, documentary credits, consignments, and open account selling, as well as banking operations. Countries can now offer their sources of funding as required without involving much of the depletion of its foreign stock of reserves. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Jagbandhu Jana. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.